The UK commercial property market has recently shown signs of stabilisation and recovery. This sector will clearly remain sensitive to the outlook for economic activity and interest rates. However, it is noteworthy that the MSCI's Investment Property Data Bank, or IPD, which provides a measure of return from directly held property by tracking over 1,200 sites across the country, totaling over £25 billion worth of value, has recorded 6 consecutive months of positive gains since August last year. Despite this, the UK-listed Real Estate Investment Trust, or REIT sector, continues to diverge from this backdrop, with the shares of many REITs continuing to trade on depressed valuations. We are not the only investors seeing opportunity and looking at this space at the current time, and in just the last week, private asset heavyweights KKR and Blackstone have been involved in approaches for 2 UK-listed property companies in Schroder and Warehouse REITs respectively. So in this week's episode, we discuss the UK property outlook with Nick Montgomery, Global Head of Real Estate at Schroders Capital. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this episode, we were joined by Nick Montgomery, who joined Schroders Capital in January 2012 and held the role of Head of UK Real Estate before his recent promotion to Global Head of Real Estate in the latter part of last year. Alongside being a member of Schroders' global direct and indirect property investment committees, Nick is also a fund manager and co-manages the Schroder Real Estate Investment Trust, ticker SREI, alongside Bradley Biggins. SREI is a REIT with a portfolio touching £500 million in value, invested across the UK commercial property sector, and looks to add value by improving the environmental performance of the portfolio's assets over time, an approach we explore further in this conversation. We hope you enjoy the discussion, but as always, please do get in touch if you have any questions or would like further detail on any of the topics referenced. Nick, good afternoon. Thank you so much for spending some time for this. How are you doing?
Very good, thank you. Very good to be here.
No, glad to have you on. So we've got this kind of regular question that we ask all of the speakers on this series, and it aims just to get a bit of an insight into you, really, or kind of how you go about your work. So we've had people kind of share anecdotes from a recent trip or meeting or research project, or even just an interesting article or book that you've come across. Is there anything you can share with us just to start things off?
Well, I guess a couple of things. So I am, for my sins, a chartered surveyor by background. So I look at things both bottom up, having worked very much with the physical real estate, but obviously now looking at it very much through the eyes of our investors. And in the case of Schroder Real Estate Investment Trust, I'm looking at it as both an investor myself, but also more importantly on behalf of your clients and other investors who are attracted by the income return that the trust offers. So my children are very accustomed to spending time on the motorway, getting off, looking at industrial estates, and then getting back on again. Equally, working in real estate, we have, to put it mildly, had a challenging few years. In fact, the nadir for me was being asked to attend a panel in the middle of last year where the title of the panel was The Undatables, which my wife and daughter found to be very funny. But I can look forward now, I think, at a recovery in real estate. And obviously, I hope that's why we're here now.
Yeah, no, absolutely. Yeah, yeah. I think the phrase "undateable" sounds like seeing the bottom of things. Hopefully, that's we start to see things like that come. Um, Nick, I guess just to kind of set the scene, I guess. I mean, you talk about the kind of challenges of the last few years. I wonder if we can maybe start with the kind of macro backdrop. Could I ask you to kind of lay out how you are currently viewing the market outlook in terms of, I guess, kind of broad valuations relative to other kind of comparable assets? How are you viewing things at the moment?
Yeah, great question. So we've had a very interesting cycle. I guess for historical context purposes, going back to the global financial crisis, the UK direct real estate market, so property level data, over a couple of years, values fell about 44%. What we've just experienced is not as severe as that, but it is a significant correction with average values from the mini budget at the end of 22 to my Datables panel last year falling, around 25%. Now, the market has seen a slight recovery, a slightly uneven recovery. So averages are still a bit misleading because, industrials and retail warehousing and parts of the residential market have done a lot better than, for example, offices. But we are nonetheless beginning to see a recovery. Now, that classic sort of history doesn't repeat, but it echoes. Why have we seen the correction? Well, the most recent correction was all about interest rates. The mini budget, meaning that obviously we saw a surge in gilt rates that then triggered outflows from, for example, open-ended property funds. And therefore, the correction was really driven by that change in interest rates. Now, in comparison, what we saw in the global financial crisis was much more about balance sheet resilience, obviously a deep recession. And, the financial crisis going into that period, average loan to values for UK commercial real estate were around 60. We went into the mini budget in a much better position with average loan to values nearer to 35%. So what we've seen is a capital markets correction. The other really interesting point to compare that GFC period with now is despite seeing average values fall 25%, nominal rents over that same period have gone up 10%. And I guess the final point I'll make is going back to sort of university and real estate, the classic sort of is a good hedge for inflation. It's not a very good hedge on the capital side because for obvious reasons, high inflation, rates rise, you see an impact on capital values. But what real estate has done and what typically real estate delivers is a hedge on the income side. So what we've seen in this most recent correction is exactly what you'd hope to see, which is high inflation passing through to higher rents. And this time around in particular, occupational levels are resilient, but it's also about a lack of supply. And that's meaning more competition for the best space, driver higher rental growth.
Yeah, no, some really important points in there. Yeah, thank you for that. And I wondered if I could pick up on. I mean, you briefly referenced I guess the wide dispersion of
Yeah.
performance and sentiment within different segments of the UK property market and elsewhere as well. It sounds like it's going to be a bit of a big question, but I wondered if you could pick up on some of those major factors that are influencing the prospects of different types of property categories. And you mentioned the office sector, which has obviously gone through a number of kind of structural changes, I guess, versus retail warehousing. But what else are you? I mean, to do with those sectors in particular and others, what else are you kind of looking at the minute?
Yeah, great question. Oh, I guess just to illustrate how polarized the market has been for the 3 years between 2018 and 2021, in round numbers, industrial values doubled and retail values halved when you look at the underlying MSCI index. Now, that's an average for all industrial or retail. And again, averages will be misleading, but it just serves to illustrate how the structural trends were fundamentally driving property values. And obviously, in the case of the industrial market, it was driven by the structural tailwinds of the shift to online, like obviously more recently, sort of near or onshoring, retailers restructuring their supply chains. And on the other side of that trade, of course, the fewer people actually you're going to physical retail destinations and that having that impact. Now, what we then saw, as I've just been outlining, is that correction from sort of 22 up to the middle of last year. And actually, interestingly, because industrial assets had become one of the most lower yielding asset types because of all that weight of capital, interestingly, industrials initially fell fastest with that rate-driven correction. Obviously, coming off a low yield, all sectors move up by the same amount in response to that gilt rate, then clearly the low yielding assets are more adversely impacted. Now, we've seen that correction now, and I think looking forward, we do expect polarization, but far less than what we have seen in the past. And that's because, um, take retail, for example, it's had such a significant correction, really, for 10 years. Nothing's been built, and yields are high in response to those capital value falls, and you are beginning to see investor interest as it's clear that certain retail assets now are a very important part of that multi-channel retailing. Retail warehousing, you can buy as a consumer through the front door, but they can also distribute out the back door. So we're beginning to see some of those retail sectors starting to recover. In the same way, our, if you like, preferred risk-adjusted sector remains multi-let industrial because, frankly, no one's building it. If you own industrial land, you're more likely to build a big box, pre-let it, rather than multi-let industrials where they tend not to get speculatively built. So there's a real shortage of multi-let industrial, and we are still seeing across our portfolio very healthy levels of rental growth that reflect that shortage, but also reflects, a relatively resilient underlying occupational base with a very granular cash flow, given all the different types of businesses that you see on a multi-let industrial estate. The most, I guess, polarizing topic is offices.
Yeah.
And our view is that there are now some really interesting mispriced parts of the office market. What we would say, though, is it is polarized within the office sector. So if you own a high quality building in the West End or the City of London, or perhaps one of the stronger regional cities, that is built to a high sustainability standard, that offers quality amenities in order that those businesses are confident they can attract talent, particularly as people are returning to the office, then actually nominal rents for those sorts of assets in those big cities have never been as high. Literally never been as high. Prime Manchester approaching £50 a foot, prime city approaching 130. So I think there are parts of the office market now where we are beginning to see investor interest, which you just have not had really for the last few years. What makes it more difficult, but also quite interesting, is outside of that prime market, it's extremely fragile. And the buying pool is very thin because investors are finding it hard to price that obsolescence risk, particularly given higher building costs, cost of refurbishment, and so on. But actually for us, where we've got a specialist asset management team, particularly where we have a team that is very focused on how sustainability requirements can be integrated within that refurbishment strategy, we think that there is a mispricing opportunity. Yields are very high, even for very good quality real estate, or at least a very good quality location. And so that's an area of the market where we're beginning to look with a bit more interest, alongside, as I say, continuing to invest in our industrial portfolio, continuing to look at retail warehousing, but also actually looking at alternative real estate types, particularly operating assets where you've got greater ability to push down inflation onto those occupiers through higher rents. For example, hotels, healthcare, etc.
Yeah, no, really interesting. It sounds very opportunistic. But lots of opportunity there still. Yeah. Nick, I wondered if I could just ask you to talk about kind of investment activity in general. I mean, we've seen some kind of trends, an upward trend in kind of corporate activity across UK assets in general. But I wondered whether, talking about kind of international investors looking at UK listed businesses, for example. But I wondered if I could ask, just given your kind of specialism in the property sector, kind of any trends you're seeing in investment activity?
Yeah, lots actually of interesting trends. In a funny way, the real estate, sort of the underlying real estate aspect is actually almost easier to reconcile or understand versus the capital flows,
Yeah.
particularly in the UK, because we've got these interesting flows. So obviously, post the mini budget, there were the outflows driven partly by DB pension schemes. Initially, obviously, dealing with the gilt crisis, but actually, once that had settled, moving to buyout or buy-in. And so, redeeming out of some of those open-ended property funds, for example. Um, at the same time, with local government pension scheme pooling, for example, we're seeing underlying local authorities that own real estate actually pooling those real estate assets. Um, I guess what we're also seeing, I think, which is interesting, is in a sort of a post post Brexit, post pandemic, post mini budget cycle, we're seeing more international investors now looking into the UK real estate market than we've seen in a long while. Whatever your views on Brexit, it did lead to reduced capital flows coming into particularly London real estate. And the correction that London has had, certainly compared with some of the other big European gateway cities, actually means London now looks very attractive versus a long-term basis, right? So we're seeing more high net worth family offices, private investment looking at prime real estate. Probably what's more interesting and more directly relevant to the space we're talking about, so the investment trust space, is increasing interest from retail platforms alongside wealth managers who've not had the exposure previously, or who have had it, but equally see this as an opportunity to get in at attractive yield, attractive discounts. So, for example, our trust at the moment, sort of an 18-19% discount to NAV, 7% plus covered dividend yield. So, you can understand why that's attractive. But I think also what makes it interesting, as you alluded to earlier, is we are now beginning to see, in particular, US private equity being part of M&A activity in the sector, where those US PE funds recognize that we are at a very interesting point in the cycle, and they can either buy assets at potentially discounts to where the true value is today, or where the value might be in 2 or 3 years' time. So again, for those reasons, it's a very interesting market in terms of those capital flows, which again goes to why we think actually today it's a very interesting point to be looking at the UK real estate market.
Yeah, no, absolutely. Yeah, we spent quite a lot of time talking about kind of macro factors and some of the kind of top-down stuff. It's been clear that from a lot of your kind of commentary and recent presentations that you and the team have given, that you kind of evolved the strategy over recent years. I mean, this isn't very recent, but and to focus on kind of this sustainability-led improvements and targeting, I think, what you call that kind of green premium on some of the assets. I wondered if, just to kind of bring that a bit to life, and kind of could I ask you to maybe draw out some examples of kind of how that works in action, how the development projects kind of leads to a value add?
Yeah, of course. As you say, we've evolved our strategy. It's definitely an evolution, not a revolution, because really what we're doing is being more upfront about how sustainability formed part of our active approach to asset management. But we are evolving our approach, and as a large manager, we have the ability to have that expertise in-house, the intel inside, if you like. So we have 6 subject matter specialists just in real estate, things like climate, net zero, social value, and so on, which my team, the Schroder Real Estate Investment Trust, can draw on to deliver the strategy. As you say, this is all about extracting the green premium. So this strategy is not so much about social value. If we can deliver that as a byproduct, great. But this is much more about how we can create higher income, more sustainable earnings over the long term. And a really good example, probably the best example we've got, the proof of concept, is an asset we bought up in Manchester called Stanley Green Trading Estate, which is when we bought it a few years ago, was a fairly tired industrial estate, but in a very good location. So not quite the worst house on the best street, but getting close. And alongside that, a brownfield site that had been used for airport car parking. Now, we bought the deal well. We have a team in Manchester, and having those boots on the ground actually helped us secure the deal. But our strategy was about how we could deliver improvements to the existing assets, but also obtain a planning consent on the brownfield site to deliver industrial units to the highest standard delivered in Manchester. So we got planning consent for 80,000 square feet. We delivered it to an operational net zero standard, so net zero in use, or what's called an EPC A+, which is the most recognized certification that your listeners probably will have heard of. And our thesis was basically, if we spend that extra 5 or 10% of cost in terms of delivering those units, the higher environmental specification, and that obviously included things like photovoltaics, EV charging points, high quality insulation, everything from cycle facilities through to B boxes, through to a section of meadow. All of those things in aggregate were allowed us to obtain that standard and go out to the market saying we have the most sustainable warehouse space in the Northwest. And it's been fantastic. And actually, we've secured tenants that we hope we'd secure. So, for example, Siemens were our first big tenant that signed up. Obviously, a huge global manufacturing business who themselves have developed sophisticated net zero objectives. And actually, by offering the best, most sustainable product in the market, I think it did allow us to push rents and quote rents which hadn't been quoted before. And Siemens, took the unit, a very good quality unit, knowing that they would have a unit where it delivered on their own corporate objectives. So it's a great example of how that additional cost was more than compensated for in that additional rent, the green premium that we generated. And the last point I'll say is, although we haven't tested it yet with this asset, there's a green premium on rent, but I think there's also a green premium on value because, an increasing number of institutional investors, pension schemes, for example, do want to own portfolios that have these higher standards, these building certifications for their own objectives. So I think at some point when we sell this, and we're in the final stages of our business plan for the existing asset, where we're just carrying out a phased refurbishment. That's taking a bit longer because we're doing it with tenants in situ. That probably will be an asset which we look to sell. And that, as part of that, obviously realise the green premium from a value perspective as well.
Yeah, no, absolutely. Yeah, clear to see where you can add value at both sides of things. Yeah, for sure. And Nick, we've got time for two more questions. I want to end on a kind of positive, looking at kind of some areas of opportunity. But I wondered if we could just talk about some of the potential risks from here. I mean, the sector has, as you said right from the start, it's gone through a period of just a significant change in the economic environment. If I was to kind of ask you, kind of given that backdrop, you talked about kind of valuations having adjusted, but are there areas of particular risk that you see in some areas of the property sector, whether it be kind of caused by debt refinancings that are kind of upcoming at much higher rates, or some other area that kind of you are kind of watchful of in some areas of the property sector?
Yeah, I think the biggest risk is back to the macro. I think. I mean, we're watching these very concerning geopolitical events unfold, and obviously that's most concerning from a people perspective. But actually, it probably means inflation being sticky for longer, and that's been our view for a little while. Which also then means that the pace of rate cuts may be less steep than the market's expecting. Now that will affect all asset classes, clearly. But I guess from a real estate perspective, I think that's more than the price. Um, you know, we are still in a market where we have a structural shortage of space, particularly in those sectors I mentioned, multi-let industrial, retail warehousing. And so when you've got an initial yield, so the initial rental yield, if you like, from real estate today on average is about 5%. In the case of our trust, it's nearer to 6. Um, when you overlay inflation perhaps running at whatever your view is, maybe 3%, actually you can construct a case for real estate returns being sort of, somewhere between 7 and 9% over the next few years, which is above the long run average. And that's without assuming any meaningful increase in values as a result of interest rates falling. So I think, what we're seeing geopolitically is clearly a concern. But at the moment, the sector's offering a very attractive initial income return. And unlike previous cycles, where you've had that sort of correction, and with GFC, the great example of that, we're not in a position where the market has a structural oversupply of space. Yeah. The banks have those memories of the GFC, and, there hasn't been the same money chucked at developers that we had, going back in that period of time. So again, there is risk, clearly, macro risk, but actually, again, the occupational markets are underpinned by inflation, with relatively resilient occupational demand, but also a shortage of good quality space.
Yeah, no, that's clear. Yeah, thank you for that. Nick, I said we've got a kind of standard opening question, but also a standard final question. It's asked the speaker for the kind of highest conviction area. And I don't necessarily want you to pick your favorite building in the portfolio, but I wondered if there was kind of a general theme that you're looking at, or area of the market. You mentioned multi-let industrials, but one area that you might pick up on as being particularly compelling at the current time.
Yeah, I at the risk of repeating myself, it's a rather dull answer. I think we do favour, multi-let industrial, because no one's building it. The occupational demand remains relatively resilient. I guess what I would say, just to finish off, is, and we sort of, looking at our portfolio and the performance we're expecting, we're in a very good position in that not only do we have the potential income growth that we believe will come through our multi-let assets, our retail assets, essentially, et cetera. In our case, we also have very good long-term fixed rate debt. And I think that's the final point, I guess, just in relation to our company, but also going back to the point you made earlier on, actually. The real estate sector has the potential to offer attractive earnings, but you've also got to look at what the balance sheet looks like, and in particular, the interest cost. And in our case, we feel very positive that our balance sheet resilience means we can add that value through actively managing our industrial portfolio, which, as I say, is our preferred part of the market.
Yeah, no, absolutely. No, really, really important point on that kind of longer term and fixed debt at the moment. Nick, thank you so much. It's been really interesting to talk to you. Appreciate your time.
Likewise, thank you.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.